right, hello, and thank you all for tuning into today's Money Show. Our speaker for today's session is Louis Navellier. Louis is one of Wall Street's renowned growth investment advisors. He is the founder and chairman of Navellier and Associates, a money management firm. Mr. Navellier specializes in behavioral finance and utilizes extensive quantitative and fundamental analysis to identify market-beating stocks. As you watch this webinar, please type any questions you have into the chat box. I'll read your questions aloud at the end of the presentation. Louis, thank you so much for being here today. The floor is yours.
Thank you. It's an honor to talk to you folks today. I'm sure a lot of you folks are wondering what in the hell's going on with the market, so I thought I'd just tell you the truth. The truth is there's nothing fundamentally wrong. We just came off of 6.9% GDP growth in the fourth quarter. That was a preliminary estimate. The economy grew at 5.7% last year. That's the strongest since 1984. But clearly, the Fed pumped a lot of money in the economy. We have a lot of inflation. We probably have something called demand push inflation underway as we fight for goods and services. And but the earnings are coming out now. They're supposed to be up 12.1%. The sales are supposed to be up 12.1% for the S&P 500. And their earnings are supposed to be up 20.1%. They're coming in better than expected, so we're probably going to get much better results. So what in the hell's wrong? Well, obviously it's inflation, okay? And we had Fed Chairman Powell yesterday in his news conference reveal a couple things. First, he said that inflation is disappointing to him, okay? It's coming in hotter than expected. And I need to warn you guys about something. Right now, we have consumer inflation on the CPI running at 7%, wholesale inflation on the PPI running 9.7%. But in December, energy prices fell. In January, they're going up. Why? Well, it's cold on the Northeast, the Midwest, the South. So that's got natural gas prices soaring. Obviously, crude oil prices are soaring with all the Russian-Ukrainian stuff, tension. So here's what's going to happen. In February, we're going to have a very bad CPI and a very bad PPI, okay? So I want you to be prepared for that. Obviously, the Fed will start raising rates in March after their meeting. But right now, we have a very strong dollar because we're going to be raising rates. Other countries are flat to negative. A strong dollar attracts foreign capital. Almost 70% of the buyers of our treasuries are foreigners right now. And the international buying pressure is so strong, the Fed can remove all its quantitative easing, which is money pumping. So we're going to get through this, but when we have our big corrections, we have aftershocks. Today was a classic example. So now, our friends over at FactSet, and I subscribe to FactSet's research, are warning that more companies are issuing negative earnings per share guidance. This is for the first time since the second quarter of 2020. The reason they're doing that is more difficult year-over-year comparisons, period. The stocks that can still sustain strong earnings and or raise prices are being rewarded. One was Procter & Gamble. Almost all of Procter & Gamble's sales increases were from raising their prices and a little currency appreciation because they're a big international company. We have Levi's today up nicely, okay? What did they do? They were able to raise their prices. So companies that can raise prices and cope with an inflationary environment are being rewarded, okay? So I want you to be very, very comfortable with that notion. But the reason the companies are warning is not because of the economy. Some of it might be supply chain related. That's why Tesla's having a hard time because they have 2 new plants and they're kind of uncertain how much they can make because of supply chain issues. But the truth of the matter is any company can raise their prices is an inflation hedge. All right, so let's look at what's really going on, okay? The chart in green are positive analyst revisions. The chart in red are negative, okay? So for the fourth quarter, okay, we have more negative revisions than positive for the overall market. But for me, the stocks I picked, I don't have this problem at all. And I have double the sales and earnings of the S&P 500. Furthermore, I'm trading at lower forecasted P ratios than S&P 500. So there's no premium for growth right now. The stocks are announcing better than expected results, are all being rewarded. I'm ecstatic. Okay. Now, you're probably wondering, Microsoft beat, and then it went up next day, then it kind of got tired. Tesla beat, but Tesla's guidance was weak. That's why they got shot, but they went up the day before. We have Apple at the close today. Apple's mostly about service revenue. The reason those three stocks are important is last year, half the returns of NASDAQ came from Microsoft, Tesla, Apple, Google, and NVIDIA. So those are flagships, and we're going to have new leadership. Okay. Tesla may not be one of them. Okay. But we'll see. We'll have some new leadership here shortly. Okay. So when we look at 2001 versus 2022, you'll find that in 2021, we had 45.1% forecasted earnings growth and 15.8% forecasted sales growth. Okay, that's stunning, but that is decelerating in the fourth quarter. Okay. Um, and then for 2022, we still have very strong forecasted sales and earnings. But, we have 9% earnings growth, a 7.5% sales growth. And that's still decent. Obviously, I'm going to be a lot stronger than that. That's my job. But the deceleration is all due to more difficult year-over-year comparisons. Because 2021, hey, strongest year of economic growth since 1984. So obviously that's a high bar, and the government's removing a lot of their stimulus. This is the Fed specifically. So we're not going to grow that fast, as simple as that. But those few stocks that can sustain strong sales and earnings momentum will be fine. All right, so we are losing the market's breadth and power here. Now, I want you to know I like this. Because when money pours into Wall Street, sometimes it goes to the top 40%, top 15%, we got to know where it's going. And last year it got very narrow and was chasing five stocks. Again, Apple, Microsoft, Tesla, NVIDIA, Google. Okay. So after this earnings announcement season, we'll know who the leaders are. Okay. And I just want to lock in on the leaders. Okay. I was fortunate last year to have 3 of the 4 leaders. Okay. 3 of the 5 leaders in my portfolios. I did sell Microsoft towards the end of the year, although it's still in some dividend accounts. But when money chases fewer stocks, that money is more powerful. It's kind of like a fire hose underneath the stocks versus a steady stream. So, just imagine your garden hose. You can change the nozzle adjustments. Okay. So if I can get more power under my stocks, I like it. And that's what happens in a more narrow market environment. So we have a leadership shift underway. These are the FANG stocks. Okay. And they're getting more volatile, as you can see. One big warning for you guys. And I'm not trying to scare you. I'm just trying to tell you straight. I'm a little ticked at NASDAQ right now because they added Lucid to their NASDAQ composite index. So I just want to discuss Lucid briefly. Obviously, they make the most fuel efficient EVs out there. Everybody loves the car. But when they went public, it was worth more than General Motors. In fact, when Rivian went public, it was worth more than Ford. The problem is if you go to a Lucid showroom, and actually we have one here in West Palm Beach, you can go to, and you give them $3,000 and you ask them when you get the car, and they can't tell you because they got supply shortages too. There's an acute shortage of lithium-ion batteries right now, which the car uses. Anyway, so here's the deal. Great car. It's not worth more than GM. And all these IPOs last year, Rivian, Lucid were pump and dumps. The venture capitalists were cashing out. The insiders were cashing out. They would sell them to something called the ESG crowd, environmental and sustainable governance crowd, people that only want to invest for social reasons. No one was looking at the fundamentals, the lack of earnings. And they thought they were doing a good thing, but they got fleeced by Wall Street. And I'm not anti putting Lucid in the NASDAQ, but they should have put it in when the insiders got out. All these IPOs have massive insider and venture capitalist selling for several months as the stock becomes unrestricted. And so it would have been fine for NASDAQ to add this, to add Lucid when all the selling pressure was over, maybe, a year from now or 10 months from now. But they added it too soon and they made the NASDAQ indices too volatile. So I just want you to know QQQ, the NASDAQ 100, the NASDAQ composite are unfortunately excessively volatile because they've added some stocks too early that they knew would have selling pressure. And I don't know what was going on at NASDAQ, but somebody was asleep at the switch. Okay, so let's look what happens when we get these big hits and then we get big reversals. So here's an example of what's happened 7 times before what's happened in this year. And you can see that normally we reverse, okay? But it takes a while. And in my opinion, the big blow off day, capitulation day was Monday. We gapped down, then we reversed, went up, and there's more volume on the upside and less on the downside. And we've been oscillating ever since Monday. And these oscillations are eventually going to diminish. So today we're oscillating, started strong and fizzled, but today's less volatile than Monday, okay? So essentially we've had an earthquake and now we're having aftershocks. And this might last another 2 months, just so you folks know, okay? So we got to let the earnings come out. We got to let the earnings shore up the stocks. We got to let the smart money buy in dips, okay? We have to have the volatility diminish. And that's where we are at this moment. So here's NASDAQ. NASDAQ was interesting. They had 4 consecutive 1% declines. And this has happened quite a few times since 1978. But you can see on average, it goes right back up, okay? Not immediately, but the next month, 3 months, it definitely does. So you are bottom fishing right now, okay? And buying stocks now, it's kind of like catching a knife. I want you to know the dividend growth stocks we recommend are an oasis. They're great, okay? They're the safest to buy. The growth stocks, pretty tough. I just buy them on dips, and I just for the webinar, I was buying a bunch of semiconductors. Okay, so we had I did this PowerPoint yesterday, and the Atlanta Fed was estimating 6.5% GDP growth. It came in at 6.9. That's the preliminary official estimate from the Commerce Department, and it's going to be revised lower, or it's usually revised lower as they get the trade numbers. But whether we're growing at 6.9 or 6 doesn't matter. We had phenomenal GDP growth last quarter. So it's time to celebrate that. Okay, now this is very important you guys understand this, and this is probably the most important thing I want to tell you. There is not a problem with the economy. There is not a problem with earnings. The problem on Wall Street are the mechanics, the games they play. So I happen to have the biggest and safest ETF out there for a lot of folks, which is SPY. That's based on the S&P 500. Do you know if you bought it at the opening and sold at the close every day since it started, you don't make any money? On the other hand, if you bought at the close and sold at the opening, you're up 994%. Now, this also happened last year. Last year, the S&P went up this ETF went up 9.7% during market hours. But after market hours, it went up 16%. So what I'm trying to tell you in a nice way is if you trade in the middle of the day, you're going to get fleeced. And the other thing that you need to know about ETFs is they have spreads. A lot of people don't know that. So all stocks have spreads, but an ETF puts a spread on something that already has a spread. And the brokerage industry gets kickbacks from Citadel. That's the big algorithmic firm that does all the trades. Because the SEC allows them to get paid for order flow. So when you buy and sell stocks, there's a kickback going back to your broker. When you buy and sell ETFs, your broker makes more money because he has a spread on top of a spread. Okay? So just so you know, on Monday, when the market was going down, I saw 7% spreads on some big, fat, popular ETFs. 7%. So if you got out Monday, They fleeced you an extra 7% on the way out. Then it reversed. And then in the last hour on Monday, if you bought, they would have fleeced you another 1% to buy. So guess how Wall Street makes its money? By spreads. So if I'm a producer of a major TV show and I got a lot of friends on Wall Street, I gotta scare people. I gotta get you freaked out. I got and I got to get the money going. So my friends on Wall Street make more money. So what I'm here to tell you is not to freak out. Don't get fleeced. And it's a lot worse than just this ETF. This is the biggest, most liquid one. So I hope you're getting a feel for how Wall Street works. And I need you to not panic during market hours, because most of the action is after market hours. All right. So we had a lot of SPACs go public last year. Rivian, Lucid were just two examples. The SEC is investigating some like Lucid. And a lot of the SPACs turned out to be pump and dumps by the venture capitalists. And then, of course, the insiders start to cash out. So I do want you to be aware of this, okay? And most of the IPOs were disasters last year. And there were bubbles that had to be pricked out there. And these are examples of the bubbles. But here's the problem. When the market goes down 5%, I can be resilient. I have stocks that don't care. Market goes down 10%, they're going to throw everything out. The baby starts to get thrown out with the bathwater. People start to sell ETFs. They start to sell major indices. Those ETFs go to deep discounts, and it just feeds on itself. So part of the problem is just of all the people as ETFs got bigger and bigger, unfortunately, they made the market a little more volatile. All right, so IPOs are cooling off. These are just some examples. We have Rivian here and Robinhood and things like that. And very few stocks going up after their IPOs. Most are going down. So bubbles are being pricked. So I just want you to be aware of that. Okay, I also want you to know the market is heavily concentrated in very few stocks, okay? And I know when you buy the S&P 500, you get 500 stocks, but it's heavily skewed. 30% of the S&P 500 is in 7 stocks. And here's the top holdings of the NASDAQ 100, the QQQ. And you can see that, you're 11.67% of QQQ is Apple, and almost 10% is Microsoft, and Amazon's got a good chunk there too. So it is Facebook, which is now Meta Platforms. So I want you to know that some of these indices aren't as diversified as you hope they are, okay? And when people start to sell these indices, they naturally put pressure on a lot of these big flagship stocks. So what are the headwinds you have to look forward to? Well, the inflation is hideous. It's absolutely hideous. And it's going to get worse when they announce the January inflation mid-February. And everybody's going to freak out, okay? So I just want you to be aware, the January CPI is going to be horrible. The January producer price index is going to be horrible, okay? Everybody's going to be freaking out. Don't worry about it. I just want you to know that. That's probably the peak, but we'll see. It's funny, the Fed knows, obviously the Fed, the Treasury Department, they all know the monthly inflation stats, and they know when they start to behave. So after June of this year, we're gonna have a little lull for a while. And so they were saying that, oh yeah, inflation is going to cool off in the second half of this year. Do you know now they're telling us it's 2023? So, oops. Okay. So we're gonna be living with inflation for a while, but that's okay. Stocks are a great inflation hedge by and large. So the yield curve is a big topic, okay? We started January with yields going higher, then they settle back down. But the Fed's going to start to raise short-term rates, and they're going to flatten the curve a bit. Chairman Powell, on his press conference yesterday, said that he can't raise rates too much because of the very low rates overseas. So I'm expecting a flattening of the yield curve, but you can see a year ago, rates were a lot lower. A month ago in red, they had risen. Now they're in green and blue, if you look last week, currently. So this is one of the reasons Wall Street freaked out. The other thing is a lot of talking heads on TV tell you this is bad for growth. They are so wrong. I can't even say it right. Okay, that is grossly misleading. Growth stocks overpower inflation. What inflation is bad for is cyclical stocks, financial stocks, Okay. And earlier this year, financials and energy were an oasis. And right now, only energy is the oasis, but it's very volatile. Okay. Don't be scared of stocks in an inflationary environment. If we can get inflation down to under 5%, which we're above now, historically, the stock market's been a great inflation hedge. When it goes 5 to 10%, it doesn't do quite as good. It gets over 10%, we do freak out. So right now we're in yellow. Okay. We hope to get back to green, and that's the goal. That's the goal. In the meantime, we lost over 2 million workers during the pandemic. Some retired, some are working, went independent. But the Fed has an inflation mandate and an unemployment mandate, and we just had new claims for unemployment today. They were better than the previous week, but they are elevated, the highest level in 3 months. We think it's weather related. The big freeze in the South, it snowed in the South. It's still very cold there. It's going to be cold this weekend. We think it's labor related, but we'll see. Okay. But if unemployment starts to go up for any reason, okay, the Fed might only have 2 rate increases instead of three or more. There's a guy named Neil who runs the Minneapolis Fed Bank, highly respected, ran the TARP program under Hank Paulson, the former Treasury Secretary. Everybody in Congress knows him. He's only calling for 2 rate increases this year. I know Goldman said 4 or more. They're wrong. They're just trying to freak the market out. Remember, Goldman, all these brokerage firms, when they freak everybody out, then they get the orders. Then they make money because they're getting all the kickbacks from Citadel. Okay. So remember that. They want to freak you out. I just want to tell you the truth. Okay. Anyway, we're doing remarkably well considering the labor costs are going up. There's a lot of productivity enhancements underway. The pandemic accelerated a lot of technological changes. So I know a lot of companies that make those changes. So let's get into our stock grading methodology. First of all, I want you to know all my research is online available for you free. And we have a dynamic versus static a system for picking stocks. And we just sell good stocks to buy better stocks. But this is how our system works. We test what works on Wall Street. And we want a pattern, okay? Here we test in growth and corporate governance and momentum, liquidity. And we want the factors on the left, okay? Because it shows they have positive returns above and beyond the market. So we're always testing to figure out what's working. Then we do this thing called alpha volatility. Alpha return uncorrelated the market. Volatility is just how volatile stock is. I pioneered this. I wrote a book on it. I've been doing it for 40 plus years. I'm immensely proud of it. It helps save your butt, to be honest with you. Then we do our fundamentals. We want to find, why is the stock having alpha? Why is it moving independent of the market? We want to find the fundamental reasons for this. Is it dividend increases? Is it return on equity? Is it cash flow? Is it analyst revisions, earnings surprises, margin expansion? It could be due to a variety of factors, okay? But then we go in and figure out what's working, and then we score the stocks on what's working on Wall Street fundamentally. And what we want is like a chart on the left. A chart on the left is a fundamental factor I like. I took the stock market sliced into 20 slivers. The factor, the top 5% is up 30%. The bottom 5%, which is line 20 there on the right, is up a little more than 10%. And as the factor decays, performance decays. This is what we look for. Now, just so you know, a lot of times when we do this testing, we get the chart on the right, which is garbage in, garbage out. So what we do is we dial it in to figure out what's working, and we score the stocks and the factors that are working. And then we give the stocks A, B, C, D, F rankings. And this is just an example how we would rank the portfolio under a total grade, our quantitative grade, and our fundamental grade with 8 tried and true fundamental variables. All right, dividend stocks are your oasis now. Here's how our dividend stock grader performs. You go to navalair.com, you can click on it, key in any stock, you can save portfolios. Just so you know, we've knocked these returns down 1.75% a year because they're registered with the SEC and they don't like us to show gross returns. So so this is how our dividend grader performs, a minus 1.75% a year. And here are our best dividend stocks at this time. We have Extra Storage Space, Kroger, National Storage Trust, Golden Ocean Group, that's one of the marine transportation companies. Devon Energy, great energy stock. So these are our best dividend growth stocks at this time. These stocks are all geared to double their dividends every 6 to 7 years. They have good yields now, but they will have much higher dividends 6, 7 years from now. Golden Ocean Group, the bottom one, did have has a 17% yield because they've been declaring some extraordinary dividends. Okay, now growth stocks are going to be fine, but they are having a tougher time now. Wall Street traditionally tells you to mix growth with value because one zigs and one zags. I don't do that. I like to mix growth with dividend growth stocks, the stocks I just showed you earlier. Value has not worked since 2009. It will work for 4 to 6 weeks and then it fizzles. And we do not recommend you buy value, even though the talking heads on TV are telling you to do that. All right, here's our stock grader. We rank stocks A, B, C, D, F. We've taken 1.75% off the top for all these criteria. Clearly, the stocks that get an A grade do better than the ones that get a B grade, etc. Again, this research is online, available to you free. Go to navalier.com, and there it is for you. And here's some of our best growth stocks. Boot Barn, Dillard's, Iramed, that's a good buy. I just bought some of that today. A Joint Corp, which is nursing homes. Shoe Carnival, we got a marine shipping company, NMM. We have also Bricks Property Management. We have ASIX, a chemical company. Choice Hotels, Encore Wire, which is copper. These are all examples of high A-rated stocks in my system. Some of these stocks actually have something called a AA, which they get a fundamental A, which is very, very hard to get. So let's highlight the fundamental A's. Dillard's, Iramed, Choice Hotels, Encore Wire. So these stocks are all extraordinary. Again, you can go to our website, you can key everything in. When you go to our website, please sign up for Market Mail. It's our free weekly commentary we have every Tuesday. It's written by myself and 4 other very knowledgeable people. It's a great, great service. We have Gary Alexander, who's an historian, wonderful writer. Myself, Jason Bodner, who's a sector technical analyst. Brian Perry, a dividend expert who's at the Money Shows a lot. And then finally, Yvonne Marchev, who's our global expert. So I just have time for one question here because I'm about to use up my time here. And so Ben has a question here. I'm conservative. When should I stick my toe back in the water? Great question, Ben. Probably late March. Okay. We're going to go through a good earnings season here. Then after earnings season, sometimes the stocks like to burp. NVIDIA will be one of the last stocks to announce, just so you know. That'll be like third week of February. Let the market consolidate a bit. I'll let it gyrate a bit. Late March, before quarter end window dressing, my stocks tend to pop at the end of the quarter because a lot of ETFs are forced to add them. And then we have another earnings announcement season starting mid-April. My stocks always have stronger sales earnings in the market, and I go in earnings season locked and loaded. So, but if I was a conservative investor and wanted to be safe, late March is your window. Right now, you can buy the dividend stocks, but the growth stocks are going to remain volatile between now and then. And again, the markets have been so volatile. We had an earthquake. Now we're in the midst of aftershocks. Best way to describe the market. So folks, it's been an honor to talk to you. I look forward to seeing you at the physical money shows. I think we have one in Orlando coming up. And so I look forward to seeing you there. In the meantime, we'll, of course, be doing the all these virtual presentations. Keep your good questions coming. Go to navalier.com, get dividend grader, stock grader, and of course, sign up for our market mail, our free weekly commentary. All our services at navalier.com are free online, so take advantage of them. Thank you again, folks.
Thank you so much, Louis. One last thing before you go. Do you mind going back a single slide? A couple of viewers just want to see that A list again so they can write it down.
This one here?
Yep, that's perfect. We'll just leave that on as we go into the outro.
All right. Sounds great. Thanks, everybody.
Thank you, Louis.